Welcome back to Bitcoin Bulletin, the show that keeps you locked into the pulse of the digital asset world. The news cycle is moving at lightning speed, and if you blink, you might miss the next big move. Today, we've got a packed show with updates that are shaking up the markets and sparking serious conversations. Get ready for some unmissable insights that you won't find anywhere else. We're diving deep into major strategic shifts, surprising performance metrics, and technological leaps that are redefining the landscape. First up, we're looking at a major player that's significantly expanding its digital asset holdings, pushing its Bitcoin stash to staggering new heights. This move comes amidst ongoing discussions and even some criticism, raising questions about the strategies being employed and their long-term implications. We'll break down exactly how much Bitcoin is involved and what this means for market dynamics. Then, we're shifting gears to examine a fascinating trend in investor sentiment. We'll be comparing the surging inflows into one of the top cryptocurrencies against the notable outflows from another, signaling a potential strategic shift in how investors are allocating their capital. This contrast could tell us a lot about where the smart money is flowing right now. And finally, we're celebrating a monumental achievement in Bitcoin's network as it hits an incredible Zettahash milestone, showcasing a more industrialized mining landscape than ever before. Plus, we'll explore the surprising data revealing why Bitcoin has been outperforming traditional assets like stocks and gold over the last decade. You don't want to miss a second of this. So buckle up, stay tuned, and make sure you're subscribed with notifications on so you never miss an update. Let's get into it. A bold bet unfolds. Bitcoin holdings surge amid strategic scrutiny. This move by a major player significantly expands its digital asset portfolio, raising eyebrows and sparking debate. In a move that underscores a bold strategy in the rapidly evolving digital asset space, one prominent entity has dramatically increased its Bitcoin holdings, pushing its stash well over the $69 billion mark. This significant expansion not only highlights a deep conviction in the cryptocurrency's long-term potential, but also positions the entity as a major force within the Bitcoin market. Alongside this substantial acquisition, the organization has also announced an increase in its SDRC dividend to a compelling 10%. This dual announcement, however, has not been without its share of criticism, as stakeholders and market observers weigh in on the methods and implications of such aggressive capital deployment. The sheer scale of the Bitcoin accumulation raises questions about market impact, potential price influence, and the broader financial strategies at play. Analysts are closely examining the funding mechanisms behind this expansion, seeking to understand the sustainability and risk profile associated with such a concentrated bet on a single digital asset. The decision to boost the dividend payout, while attractive to shareholders, also adds another layer to the financial puzzle, prompting discussions about capital allocation priorities and the balance between reinvestment in digital assets and shareholder returns. This narrative is particularly compelling given the current market climate, where institutional adoption of Bitcoin continues to be a key driver of price action and investor sentiment. The entity's proactive stance and substantial commitment signal a clear intent to leverage the growth potential of Bitcoin, even as it navigates the complexities of market volatility and regulatory scrutiny. The implications extend beyond the immediate financial metrics, touching upon the broader narrative of digital asset integration into traditional investment portfolios and the evolving definition of strategic reserves. As the market digests this news, the focus remains on the long-term vision and execution of this ambitious strategy, with many eager to see how these bold moves will shape the future of both the organization and the digital asset landscape. Market watchers are divided, with some applauding the forward-thinking investment and others questioning the inherent risks and funding sources. But what does this mean for the broader investor sentiment? Stick around as we explore the fascinating interplay of surging inflows into one major cryptocurrency versus the outflows from another. Investor sentiment sees a stark divide. Ethereum's inflows soar while Bitcoin faces outflows. A significant shift in capital allocation is underway, potentially signaling a change in investor preference. In a captivating development that highlights the dynamic nature of investor sentiment, recent data reveals a striking divergence between the flows of two of the most prominent digital assets in the market. Ethereum, the leading smart contract platform, is experiencing a surge in inflows, attracting substantial new capital and indicating a renewed wave of optimism and investment interest. This influx suggests that investors are increasingly viewing Ethereum as a compelling opportunity, potentially driven by recent upgrades, ecosystem growth, or anticipation of future developments. The network's ongoing evolution, particularly its transition to a more efficient and scalable proof-of-stake consensus mechanism, may be playing a crucial role in attracting this positive momentum. Simultaneously, Bitcoin, the flagship cryptocurrency, is witnessing notable outflows. This trend of capital leaving Bitcoin, while not necessarily indicative of a complete loss of faith, suggests a reallocation of assets by some investors. Several factors could be contributing to this outflow, including profit-taking after recent price appreciation, a perceived lower growth potential compared to Ethereum in the current market cycle, or a strategic shift towards assets offering different risk-reward profiles. The contrast between Ethereum's booming inflows and Bitcoin's outflows paints a complex picture of the current investment landscape. It suggests that while Bitcoin remains a foundational asset and a store of value for many, a growing segment of the market is actively seeking opportunities in other areas, particularly those with significant technological development and ecosystem expansion. This strategic shift could have profound implications for the market capitalization and price performance of both assets moving forward. Analysts are closely monitoring these trends to understand the underlying drivers and predict future market movements. Whether this is a temporary adjustment or the beginning of a sustained trend remains to be seen, but it certainly underscores the importance of staying informed about the nuanced flows of capital within the digital asset space. This divergence is sparking considerable discussion about where investors see the greatest potential for growth and innovation. Speaking of innovation and growth, get ready for some incredible news about Bitcoin's network reaching a groundbreaking computational milestone. Bitcoin's Zettahash leap network hits unprecedented milestone, signaling industrialized mining era. The network's computational power has reached a new zenith, marking a significant evolution in its infrastructure. Bitcoin's network has achieved a monumental feat, crossing the 1 zettahash per second, 1 ZHS, threshold on a 7-day moving average for the first time in its history. This extraordinary milestone, first briefly touched upon earlier this year and now sustained, represents a massive leap in computational power dedicated to securing the network. A zettahash is an astronomical unit, equivalent to 1 trillion gigahashes or 1,000 exahashes, underscoring the sheer scale of processing power now at play. This surge in hash rate, growing from approximately 800 exahashes per second at the start of 2025 to this record level, is a direct testament to the increasing sophistication and deployment of mining technology. As a consequence of this immense surge in mining power, the network is preparing for one of the largest difficulty adjustments seen this year, exceeding 7% and pushing the difficulty to a new all-time high of approximately 138.96 trillion. This adjustment mechanism, designed to maintain a consistent 10-minute block production time, highlights the network's adaptability and robustness in the face of escalating computational input. The current average block time hovers just slightly above the target, indicating the constant fine-tuning occurring within the protocol. This rapid expansion is largely fueled by the dominance of application-specific integrated circuits, ASICs, such as the latest Antminer and WhatsMiner models, which offer unparalleled terahash output and energy efficiency. These advanced machines, coupled with optimized infrastructure and access to cheaper electricity, have propelled mining operations into an industrial-scale paradigm. However, this industrialization comes with a significant trade-off for miners. Profitability is being squeezed. Transaction fees, a crucial revenue stream, have fallen to below 0.8% of block rewards, reaching their lowest point in years. Even with Bitcoin trading near $110,000, the hash price, a measure of the value generated per unit of hash rate, has dipped below $55 per petahash per second, reversing earlier gains. This challenging economic environment makes solo mining increasingly impractical for the average individual, with success rates becoming akin to winning a lottery. Despite the odds, the network's security and decentralization remain exceptionally strong, bolstered by this immense and growing computational might. The Zettahash milestone is more than just a number. It's a clear indicator of Bitcoin's maturing and industrializing mining landscape, reinforcing its position as a resilient and powerful digital asset. This unprecedented hash rate growth paints a vivid picture of Bitcoin's ever-evolving and increasingly industrialized mining sector. But how does Bitcoin's long-term performance stack up against traditional investments? We've got the surprising data next. Bitcoin's decade-long dominance, outperforming S&P 500, gold, and real estate by a wide margin. 10 years of data reveal Bitcoin's remarkable ability to generate superior returns, even accounting for volatility. Over the past decade, from 2014 to 2024, Bitcoin has consistently outperformed traditional asset classes, including the S&P 500, Nasdaq, gold, U.S. real estate, and even 10-year Treasury bonds, according to a recent analysis by Macro Investor Kruger. This remarkable performance is particularly striking when considering inflation and capital gains taxes. Using assumptions of a 7% true inflation rate and a 20% capital gains tax, Bitcoin delivered an astounding 46% real return over the decade. In stark contrast, the Nasdaq saw a real return of only 4%. The S&P 500 managed 2%. Gold yielded a meager 0.5%. U.S. real estate experienced a decline of 1%, and 10-year Treasury bonds posted a negative real return of 4%. These figures strongly suggest that Bitcoin has been the premier asset for wealth generation over the last 10 years, prompting Kruger to advise investors to pick the right weapon. While Bitcoin's superior returns are undeniable, market commentators have consistently highlighted its significantly higher volatility compared to traditional assets. Professional trader Adam Bakke acknowledges Bitcoin's proven status as a strong macroeconomic asset, but cautions that its historical annual swings of around 40% demand a robust risk tolerance. He recommends that investors who cannot stomach a potential 40% drawdown might be overexposed and should balance their Bitcoin holdings with safer assets like gold or treasury bonds. Despite the volatility, Bakke believes Bitcoin deserves a portfolio allocation, especially given the success of Bitcoin ETFs and increasing institutional and governmental interest. He notes that while Bitcoin has shown a strong 2-year trend, momentum might slow towards the end of the year, though timing remains uncertain. Some respondents in the discussion countered that Ethereum might present a stronger long-term case, while others defended gold's enduring value as a hedge, despite its limited upside potential. The data unequivocally positions Bitcoin as a top-tier performer over the last decade, rewarding those with the fortitude to navigate its inherent price fluctuations. Its consistent outperformance across various economic conditions underscores its unique value proposition in the modern investment landscape. This decade-long trend underscores Bitcoin's resilience and potential as a long-term wealth-building asset. That's all the deep dives for today. But don't go anywhere, we've got a lightning round recap coming up right after this. And that's a wrap on today's Bitcoin Bulletin. We've seen Strategy push its Bitcoin stash to over $69 billion while raising its SDRC dividend amid criticism. We also analyzed Ethereum's surging inflows versus Bitcoin's outflows, signaling a potential shift in investor sentiment. Bitcoin's network hit an incredible Zettahash milestone, showcasing an industrialized mining landscape, and we revealed why Bitcoin has outperformed the S&P 500, gold, and real estate over the last decade. If you found this information valuable, smash that like button, subscribe to Bitcoin Bulletin for all your crypto news needs, and ring that notification bell so you never miss an update. Share your thoughts in the comments below, and make sure to follow us on all social platforms for real-time updates. Thanks for watching, and we'll see you in the next one.